Are you in the beginning of the process to get your home loan sorted? Do you know what percentage the lenders will consider from your assets? And when the lender mortgage insurance will kick in? And when do you need to offer guarantor? Join me and Vorleak today to learn more about your collateral.
Welcome to the Money DNA channel. Money DNA is a financial fitness community where we bring everything about money and beyond money concepts in life to help you create healthy money habits and to be financially fit for good. It is important to understand that the advice is general in nature and does not take into account your personal objectives, financial needs, and overall well-being situation, and it may not be appropriate for you.
Hi everyone, it's Winnie here. Thank you for tuning in into Money DNA. We'll be looking at your collateral, what you can offer in exchange, including what you got and potentially your guarantors. Join me today is Vorleak Srey at Veer Finance Advisory Services. Vorleak has been in finance and banking industry for 16 years. And since 2021, Vorleak brought her rich experience and knowledge in starting her own business, Veer Finance Advisory Services, which provide various finance solutions and small business planning advisory services to her customer. Apart from running her own business, Vorleak and her family also runs a Cambodian restaurant based in Central Perth called My Baran, and they are the finalists of 2021 Gold Plate Award. So definitely worthwhile for you to check it out when you are in town. So Vorleak, welcome to Money DNA again.
Thanks, Winnie. Thanks for having me. I'm a bit dusty from last night finalist awards.
Yay! And congratulations for that. What a great achievement that you have done. So how long have you been running the restaurant?
It's been about 3.5 years now. So we're really quite new in the industry. So it was really good last night to sort of share that experience. We feel honoured just to be there as a finalist. I mean, having only started like 3.5 years ago, like I said, and being family run and owned. So very humbled.
Yeah, and I think that one thing good about that is because you are running a business with your family, so you can just bring up another level of closeness to your family. But at the same time, it could also bring up some conflicts in the relationship, I was seeing.
It has its moments, absolutely, in any business partnership.
Yeah, and I think that having 3.5 years to achieve what you got right now is just amazing. Maybe one day you are going to be able to share with us some experience from that, because I think that the very first time we talk about the mindset that owning a property is one of the Australian dreams, and I guess that running a cafe or a restaurant is a lot of people's dream as well.
Yeah, for sure. I think, having that concept of like your own baby, your own business and being self-employed. And it is the Australian culture and a lot of cultures in terms of like food and coffees.
Yeah, for sure. So let's jump into what we're going to talk about today. We have touched on with the first two important steps to when it comes to lending. So the first time we talk about having the right mindset, and then we discuss about the second part, which is your characters. So for those who haven't seen these videos, you can definitely check out the videos here. But V, can you please just quickly recap what we talked about last time in regards to characters?
Yeah, sure. So last episode we spoke about the importance of understanding your credit history and what that looks like from a lender's perspective. Have you met your repayments on time? What outstanding debts you've got out there? Just even to understanding your residential history along with your employment history and what that might be perceived as. How good of you as a borrower are you? Like, are you jumping from job to job? How stable is your income? And I think the main thing really now in this sort of day and age is your consumer credit file, and then having a look at that through Vita. So as we touched on last time, if you haven't done so, jump on the Vita Equifax website and get your free credit file.
Yeah, that is so important. At the same time, like you said, it's free of charge once a year. So I think that everyone definitely need to check it out if you haven't done it yet. And I think also last time you used the example of getting to know about your character is just like knowing a new friend. or examples that I mentioned is like you are getting into a relationship that you really need to check out who you are dealing with. So same thing as a relationship, you are going to get involved with the lender itself. The lender really need to know who you are, your background, and also everything that you have done so far. Same thing as, do you think that the lender that you're dealing with are going to be a right lender for you? So
Perfectly put, Winnie.
Yeah. So today let's talk about the second, I guess that not the second, the next one, which is a collateral. I guess for many people who are on this journey, wanting to know what you mean by collateral, and if the collateral is going to be so important, what can be collateral and why is it so important for us to know?
Yeah, so collateral is an item of value used to secure a loan as such. And if we speak specifically around, say, home loans or residential lending, it can come in the form of, say, cash, so your savings, what you've got, equity in your existing property if you do have an existing property, and even in the form of, say, a guarantee from mum and dad. Collateral is important because lenders want you to have some skin in the game. They're taking a risk by lending you that money. And so they want you to take a risk as well. So what are you going to be able to offer them in case of default? I guess it's a second way out for them. And like I said, in the case of you defaulting, it's where they can recoup their losses.
I like the way that you explain about things as a second way out for the lender. For them to recoup if there's any risk that they have, and at the same time also want the borrower to take the responsibility and also the risk as well. So earlier you touched on with the assets, and also the assets need to have a value. You also mentioned about the saving itself, which I assume is going to be cash or term deposit for some people, let's say, and also the properties itself. What about some other assets like shares or like managed funds, Bitcoin, let's say? So are they going to be this, this kind of portfolio or this kind of properties or assets are going to be considered as collateral as well?
Yeah, so I mean, like if you look at business lending as such, anything from my perspective or from like a non-traditional lending perspective can have value. So if you're going to use shares as security, then absolutely it can be taken on and it can be lent against to a certain value of it, but it'd be a different type of loan that's used to secure against. So Bitcoin is a very, very controversial topic at the moment, and such big noise out there right now with cryptocurrency and digital currency. So our traditional lenders these days just don't recognize Bitcoin as a type of asset at all whatsoever. Although quite recently, CommBank has announced that they will be utilizing digital platforms to allow people to trade on digital currencies now.
Interesting.
Yeah. But at the moment, no, Bitcoin or anything like that can't be used as security with our traditional lenders or even with any of the non-conformings. But shares, most definitely. It can't be used to purchase a home, though.
Yeah, so I guess that once we lay out things that it could be a collateral, and also you were saying that it depends on the risk that the lender consider, it probably is going to lead into our next question is, if they are going to be considered as a collateral, what sort of percentage or what sort of value is the lender going to consider on each of the assets that we just described earlier?
So if we speak about the three main types of securities that's offered to a lender for, say, a home loan, generally speaking. So most lenders will take up to 80% to the value of, say, a property, or otherwise known, if you've ever heard of the terminology LVR getting thrown around, so 80% of the value of the property without lender's mortgage insurance. So say you purchased a property that is worth $500,000, then the maximum lend against that would be $400,000 without LMI.
Sorry, can you, earlier you mentioned about the term as a LVR. What does that stand for?
The LVR stands for loan to value ratio. So the loan in terms of the value against the property, the ratio between that. So yeah, going back to the example of, say, a property is worth 500,000, then 80% value against the property is a $400,000 loan. So then that's a 20% sort of haircut or leeway that lenders are providing.
So what you're saying is, let's say that if the investor or the home buyer is looking for a property worth about 500, and then if the lender is looking at 80% of LVR, what it means is the lender usually is going to be able to take on the risk to lend you about 400,000, and then we have to take out the rest of the 20% on our own. Is that right?
That's exactly right. So that 20% will either need to come from, say, cash or another property utilised as security or guarantee from something else. So the maximum lend that most lenders can go up to is 95% of the value of the property. This is where we're taking property as security, but that comes with lenders' mortgage insurance. There are other lenders out there that will go up to 90% with lenders' mortgage insurance capitalised on top of that. And of course, when you have lenders' mortgage insurance applicable, then the maximum LVR set against, depending on the different lender and the purpose of the borrowing as well. So for example, if you're borrowing that for an investment property, unlikely you'll be able to go up to anything past 90% in this day and age. But it's to buy an owner-occupied property, then yes, you can generally go up to 95% of the value of the property.
So what you're saying is, obviously the purpose of the property that you purchase are going to also impact on the LVR that you are going to look at. Also, another thing I think that the audience probably need to know is, because you mentioned about 80 to 95, another important criteria is the quality of the property or the assets itself. And that probably also depends on where the location, the quality itself, and sometimes we may even have a valuer to look at the property and make the valuation. Is that right?
Yeah, so that's a good call out, Winnie. So most of the time with residential lending, in terms of the properties, most lenders will have what they call a postcode restriction. So depending on the location, like you mentioned, of the property, will set the maximum LVR guidelines for that particular property. So anywhere in the metro or regional area, 80% is the general rule, and being able to go up to 95% for owner-occupied purposes. Let's say it's out in a regional area, really hard to get to. Maybe, for example, say up north in WA, like Port Hedland, Karratha, those likes, LVR would be at 70% maximum. Even in, say, our metro areas, the type of security, as you mentioned before, not just location, can also set those maximum guidelines where, say, if you're purchasing a really high density apartment, and it is under 50 square meters, then most lenders will only lend up to 70% with no exceptions onto that.
Yeah, I think that is a really important key points that we need to share with the audience, because a lot of people are going to hear different numbers and different voices. Some people are looking at 80%, 70%, 60%, or even 95%. But do bear in mind that the bank, lenders, mostly are financial institutes, they are risk management businesses. So what they are doing is, of course, going to look at all the assets or all the collaterals that they owned and assess that how risky that might be. And based on that, they are willing to give you a percentage of the lending to you. So I guess that was the reason why you can see that there are going to be quite a bit of big range of the ratio when you are going to look into the collateral itself.
That's exactly right, Winnie.
Yeah. So that's the property itself. What about others? Like cash, is it going to also apply for the 20% rule, or is it going to be as a $1 to $1 kind of things?
So cash is generally held in a term deposit for security purposes, in which case it's locked in and then used to secure against the loan itself. So cash is lent against dollar for dollar. So if it's worth 100,000, the bank will take 100,000 of the value, and that's because essentially cash doesn't really depreciate in value as such. it's locked in for that period. Well, not so much anyways, unless you talk about inflation, but that's a whole nother topic.
Yeah, that's right. And I guess that also back to the risk management for the lender. When we're looking at collateral, one of the things that you also mentioned about that is this is a second way out for the lender itself. So they need to see that if they are going to come to this stage, how likely are they going to be able to exchange their assets back? So for cash, of course, they can just release that cash and then get the cash back. When it goes to be the property, they need to make sure that the property is going to be in the right condition, right location, and they are going to be able to sell. And same thing as what you earlier mentioned about like other managed funds shares and also I guess Bitcoins and also any other type of means of the assets. They need to know about how long it's going to take, how risky they are going to take, what type of volatility that you are going to go through.
Yeah. So when if you're looking at from a lender's perspective, or you're putting yourself in the shoes of the lenders, if you were going to lend somebody money, then you want to make sure that if they can't repay you, what have you got available to recoup your losses? And like you said, the main thing that they're looking at here is the quality of the security, the type of security itself, and the market for the security. So, how easily can they sell that? Say, for example, with the house, there's absolutely a primary market for it. So there's going to be people out there wanting to buy houses or properties all the time. But let's say you're offering a piece of artwork worth $1 million as security. Yes, it might be worth that value, but how many people out there are going to want to buy that?
Yeah, true. Because right away I just thought about, some people collect wine, some people collect on vintage bikes. Would that be also a type of things that you can consider as part of the collateral to the lenders?
Not in traditional lending, no, absolutely not. Yeah.
I see. And I guess that also another question that we have is in terms of using the cash or term deposit, because we're going to lock in as a collateral, that may bring up to another question is, are you going to utilize the cash to put down as your down payment rather than, take out additional debt? So that probably is going to be some other things that we can talk about that in the later time.
Yeah. So there are certain scenarios out there where lenders, smaller lenders, offering what they call gap lending. Very sort of in-depth topic that we can get into as well, because there are certain risks involved with that at the same time.
Yeah. Also, I guess that my next question is, because earlier you mentioned about the mortgage insurance, lender mortgage insurance, LMI. I think that a lot of audience probably wanted to know more about that. And also, I think another thing is for the first home buyers, we also know that some of the governments or even the state governments have the grant. Can you just quickly introduce about these two concepts to our audience?
So lender's mortgage insurance, I'd like to put it this way. It is a dead lump sum payment that you make to the bank at the very start of your loan, so the inception of the loan. And lender's mortgage insurance is calculated depending on the value that you lend against the property, so the risk involved. So at 80% lend, meaning you've got a 20% deposit, there would be no lender's mortgage insurance. In general, most scenarios. Between 85%, 80 to 85%, your LMI is reasonably okay, because the risk there's still risk to the bank, but not as high, meaning you've got a 15% deposit at least. 85 to 90% it doubles, and then 90 to 95% it pretty much triples. So LMI is paid to the bank's insurer, and different banks have different insurance companies and have different policies. So just because you've been approved by the bank within their policies for the loan, it doesn't always mean that the lender's mortgage insurance company is going to approve you either as a borrower. So when you are borrowing with lender's mortgage insurance, you go through two checking points when it comes to the actual application process itself.
Sorry. So because we're talking about insurance, I guess my next question is, who is being insured? With this lender mortgage insurance, is it going to insure me as a borrower or the lender as a bank?
Actually, it doesn't insure the borrower at all. So it covers the bank in the event of default. And then that's why I go back to what I said before. It is a dead payment made to the bank in the event that, let's say, you bought a property at 500,000, your loan is 450, meaning you only had a 10% deposit. So your LVR is 90%. And for whatever reason, you had to sell the property and you couldn't meet those repayments to your loan. And you could only sell the property for, say, 400,000. Your loan is 450. There's a $50,000 shortfall there. So that's when Lenders Mortgage Insurance will come in and pay that $50,000 to the bank. And that way the bank is not at loss.
So what you are saying is actually the borrower is paying the premium for the lender mortgage insurance to secure the lender to get the full amount that they're lending out to the borrower.
Yes, so it's reducing the risk to the bank itself, and lender's mortgage insurance can be very expensive. So depending on the value of your property will also depend on the premium. So you're looking at generally, let's say, a $500,000 property for 95% lend is about $18,000 to $26,000 in upfront premiums that you have to pay. Which most of the time will come from your pocket. It can't be lent against.
Yeah, and that's once you are paying for the premium, it's a dead money. You're not going to be able to get it back. And I guess that's why we sort of keep emphasizing the fact that making sure that you are going to have enough as a collateral for you to not trigger the lender mortgage insurance, because you are definitely not going to be the one to be insured. Rather, you are paying the premium to make sure that lenders are going to be protected. But then another scenario is nowadays a lot of people actually mention about the first home grants. So, and they also mention about something as have you 5% or 10% of the down payment. Is that true?
Yeah, so for first home buyers, a lot of the time the government will have some schemes out there to help people get their foot into the market. So at the moment, there is a couple of schemes called the First Home Buyers Low Deposit Schemes. And that was introduced last year, actually, and re-extended and reintroduced again this financial year, 1st July 2021. So what that is 10,000 allocations from the federal government to help first home buyers that if they do only have a 5% deposit, then the government will guarantee the remainder 15%, meaning that they don't have to pay lenders mortgage insurance. In saying that, you still need to prove that you can repay the loan in terms of having your first way out evidenced. Second way out in terms of your security or your cash deposit is backed by the government. So it's like a government-backed guarantee loan. And there's only certain lenders that have those allocations to do that. Each state and territory will also have their own, what they call, I guess, like a government scheme, like the First Home Buyer Assistance Scheme up in the Northern Territory. And one particular bank that would do that is People's Choice Credit Union, where similar concept to the federal scheme of the First Home Buyers Low Deposit Scheme. But the amount that the government is guaranteeing, that extra 15%, is charged at a higher interest rate. So say, for example, here in WA, it's called Keystart, which is the lender. So again, you only need to have a 5% deposit or even a 2% deposit, but you do have to meet all those other criteria, such as having income threshold of under 120,000 for a single person. And again, your interest rates can be higher. I'm talking almost double to the traditional banking or mainstream lenders.
Right. And it's very much like a trade-off, isn't it? So if you are going to be able to have less amount as a collateral, you might need to also request to pay the mortgage insurance, or whether it's going to be a high interest rate. It all depends on the risk itself. But I guess that what we are discussed so far is more about the options. There are more than one options that you can consider. Sometimes there are going to be some support from federal government or state government to really help you to get into the market. But however the market and also the option might be, you still need to depend on your personal criteria and circumstances. And I guess that's the reason why discussing something like this with a professional like a broker like V itself is going to really let you understand about what options you have, and then also weigh up what is going to be the most suitable criteria in the scenario for you.
Precisely.
Yeah. So I guess my next question is, now you at the very beginning mentioned about a guarantor and guarantee. So what situation are we going to require to have a guarantor and guarantee then?
Yes, so in residential lending, so I think let's sort of simplify this in the sense of, say, a home loan, rather than anything else, where guarantees can be provided. So in that space, lenders will only generally take what they call a family guarantee, or another word for it is a family pledge. And generally it comes from mum or dad, where, you know, parents want to help get their kids into the property market, or otherwise get them out of home so they don't have to deal with them anymore.
Yeah, true.
Yes, yeah. So, you know, often we see, say, a young person finish university, they've landed themselves a really good full-time job with a good income. But during that time in uni, they haven't been able to work to save for a deposit, which is required, you know, to put in to secure a loan as such. So in this scenario, mum and dad would come in who has a property, preferably an investment property, with equity that can be used as security to help that person get into their first home. So an example would be, again, $500,000 property that they want to buy, no deposit coming from the borrower itself, but mum and dad will have $100,000 in equity against their home, or even in cash. They can put in a term deposit in their names, use as security, as a guarantee for that particular home.
What about partnership? Let's say husband and wife. Would that be? Can we consider as a guarantee? Because earlier you mentioned about family members. You know, spouses can be definitely the guarantee itself as well.
Yeah, so spouses absolutely can be guarantees themselves. So again, going back to what you said earlier in terms of there are a lot of options out there for you. So it's really important to discuss what your personal circumstances are and what you're trying to achieve here.
Yep.
So when it comes to spousal guarantees, then you've got to sort of ask the question, why is one person purchasing the property without the other person?
True.
Yeah, and in that scenario, what is it that they're trying to achieve here? So there's been instances in the past where, you know, the husband earns a higher income and wants to buy an investment property, and to have that in just his name solely for tax purposes, but needs to utilize the family home, which is held in joint names, as a guarantee or the equity to purchase the investment property. And that's when spousal guarantees can come into play. But there's got to be a financial benefit or a link to that. And hence the reason why most of the time it is only family guarantees that are taken, because there's got to be a benefit to the other person that's providing a guarantee. So the benefit for mum and dad is the fact they're helping out their child or their, you know, their children. Benefit for a spouse would be to further build on wealth or acquire assets.
Yeah, and I think that especially nowadays, because of APRA definitely restrict the whole rules, and then especially on this guarantee piece, they have a special requirement for the lenders to meet these needs. That means that every time when you are going to get into a lending, of course, the lender is going to ask you if you are going to introduce the guarantees into this scenario. They wanted to know that if that person understands about their own responsibilities, their risk is going to take, and also what sort of financial benefit they are going to get. And I guess that for me, even with the last, I think now is November. So this year, I have two particular examples that I just mentioned about the guarantee issue. So one is I think it's an uncle wanted to help the niece to start her own business. And the business owner herself didn't really have any business experience. And her hubby also didn't really have any experience. But just because the uncle really wanted to help the niece to start up her own business and also start up from the ground, he was being himself as a guarantee. How we didn't know is, of course, 2 years later, this business went sour and then issued a bankruptcy. And during this time, the person already left. And then, so the uncle, who is 84 years old, have to take on all the risk. So this kind of things happens from time to time. A lot of times, a lot of people will say that, it will never happen to me, especially when it comes to family members. Family members will never betray me. It's not so much about betrayal, but, money is definitely going to be an iffy subject. And when it comes to a niece, sometimes it will just get really ugly.
Yeah. So there's going to be unforeseen circumstances that you can just never predict that might happen. And in this scenario, this is why lenders look at the commercial benefit or the benefit in providing a guarantee, and whether they're doing it under their own will as well. So a lot of the time, when you're signing a guarantee document with a lender, you do have to seek legal and independent advice before you do sign those documents.
Yeah, that is so important. And thank you for reminding us about this, because I do see that a lot of borrower didn't really understand about the reason why. They just thought that, the lenders are getting a little bit too tricky about this, or asking too much. How come this kind of things never happened in the past, or are never being asked? It's just because we're actually trying to protect our borrowers nowadays. Yeah. So earlier you mentioned about the collateral that is our subject today is the second way out, but at the same time you also mentioned about the first way out. So would it be fair to say that offering collateral is one important element, but there are going to be another criteria equally important that we need to consider, which is your ability to repay the loan?
Yeah, definitely. So when the lenders look at, say, borrowing, it's, they judge it on two specific things, which is your first way out, your ability to repay the actual loan itself. And if you can't, then what is your second way out, which is your security. So security is important. So if you're thinking at it from, say, a lender's perspective, and we've said this before in the past, would you lend somebody money without having any security in place? Let's say a stranger as such, and you're in the business of doing that. So that always wants to get in the game. So your first way out is your ability to repay, just as important. And I guess that's another topic that we can cover off on the next episode.
Yeah, definitely. So if we are going to summarize what we discussed today, obviously there are going to be so many options that you can choose from. When we look at the different types of the collaterals, from cash to the properties, there are going to be some options that you can consider. And then also depends on the quality itself and also the type of the collateral that you have. You may also be in request for a different LVR. And then based on that, of course, you also need to consider how much you are going to take on as a risk for itself. So the best way for you to do is actually talking to the professional bankers or brokers. People like V will have all the knowledge that you can discuss your options with. So V, what will be your key takeaway for this then?
I think in terms of collateral, and if we put it this way, let's just go back to our very first conversation around mindset and having a strategy into why you're doing this. So, there are so many options out there and so many different ways that you can get a loan, whether it be through, cash as security, through property, or through guarantee as such. What is it that you're looking to achieve? Do you have enough in savings today to get into your first home? And if not, then do you need to just wait a little bit longer to save more? Or is having lenders mortgage insurance kick into your scenario beneficial now, depending on what it is that you're trying to achieve and the time frame against that? So sometimes it's not just about saving a lot of money to get there to avoid LMI. It could be that, you're potentially doing both depending on your strategy. So it is really important. I think my key takeaway from here is really sit down, talk to somebody, work out what it is that you're looking at doing, what your strategy is, and looking at all options that are available.
Yeah. And I think that especially if someone take on the holistic ways, like V and I are actually working as a team that helping you to really get to where you want to be in terms of how you're going to make sure that you are going to have a healthy cash flow, or whether you are going to have a right amount as an asset. Those are things that we can definitely have a discussion with you or even help you out with things. So next time, what we are going to talk about, which is your first way out, which is your capacity. Your superpower as your income to identify how much you can borrow and your monthly commitment. So if you like what we share and think someone may benefit from the content, please like, share, and subscribe our channel. And if you'd like to book a complimentary consultation about your money DNA, you would like to contact V to discuss about your lending needs, the contact and the link is going to be down below. You can also leave your questions and comments below, and we'll come back to you as soon as possible. Thank you for joining us today, and please keep financially fit and healthy, and we will see you next time. Bye.